So is the bond market really telling a different story with the 10-year yield barely budging on news of this tariff delay? Let's bring in Jim Bianco, president of Bianco Research. Jim, thanks for being with us. You know, we've had some pretty extraordinary moves in the bond market, particularly when you take a look at the moves in the 10-year yield, the 30-year yields as well. And so today we had this risk-on rally in equities, and we had a bond market that didn't really move too much. What's your takeaway?
Well, I think the stock market, as you guys were talking about a minute ago, is all about trade, and it's all about tariffs, and it's all about saving Christmas. But if you look at what the bond market's been doing, it hasn't been about trade. It's been about a global slowdown. This started well before August 1st. It has accelerated through the Fed meeting when Powell did not deliver 50 and did say mid-cycle adjustment. The yield curve, the one that matters, I believe, is the 3-month 10-year, has been inverted since May. And the world numbers from global growth are slowing dramatically, and to the point where you've got now almost half of the world is at negative interest rates, ex the United States. So the bond market is sending a clear message. There is a slowdown going around the rest of the world. Trade was probably just a piling on penalty, but removing that is not going to remove the fact that the world is slowing down. That's what bonds are reacting to, and it's sending a message that the funds rate is too high through the inverted yield curve, 3-month 10-year, and the Fed is slow, and it's getting more and more worried that we're going to have a mistake.
Okay, so it's still a barometer of global growth concerns at this point. But does the fact that the tariffs, or some of the tariffs, have been rolled back at least until December 15th, does that put a different floor under the 10-year yield, for instance? I mean, when so many people were saying a test of 135, the prior low, was in the cards, does that view change, do you think?
I don't think it changes a whole lot. What you really need is, look, if you really want to talk about global growth, we really got to go to what's happening in Europe. You know, Tim mentioned the ZEW index, the lowest since 2011. That was not a good time, 2011. The German industrial production numbers were an absolute disaster last year. Last week, excuse me, minus 5% year over year. The only time that happens is when they're in recession. And a lot of people are looking at Europe and saying, it's not, are they in recession? It's how bad is the recession? And we're looking at Japan and we're saying they can't get out of their own way and they're going to raise taxes. And we've already got negative GDP numbers for the third and fourth quarter being estimated out of Japan. This is the problem that the bond market is seeing. We look at the United States, we see it's all okay, but around us is where the problem is.
So, Jim, it's Tim. So I agree with you, obviously, on Europe. We've talked about that. At what point do you think, though, because the Fed pivoted, the Fed was offsides, the Fed's made an adjustment, bond markets, the 10-year's been cut in half. At some point, the leading indicators, which you rightly point out, were leading us 18 months ago to where we are today. Does the global dynamic of the global economic sphere tell us that we're supposed to be going significantly lower from here? Because I think we've made a massive adjustment, and as scary as it is to look at global interest rates where they are, and you could still make an argument we're still inside of 2008, this is something that we're slowly healing on.
Yeah, I think, when you look at the bond market, you're right. It has made an adjustment around the rest of the world. That's why half the yields are negative. But the U.S. has been slow. The only thing that's even come close to its all-time lows is the 30-year. It just essentially touched it today for the first time. So our bond market is now, the problem we face is it's out of line. You know what one of the highest interest rates in the developed world is right now? It's the funds rate at 2 1/8. Only the 30-year and the 15-year Italian yields are higher. Everything else is lower. That's never been the case that the funds rate's been that way an outlier. So I think what the bond market is looking at is this low stuff. Yeah, you could probably make the case that we're probably closer to a yield low around the rest of the world. But in the U.S., it looks like it's early innings for rates to fall because we're so far behind everybody else.
Jim, thanks for joining us. We appreciate it. Great to see you. Jim Bianco, Bianco Research. Let's trade this. And, today, I don't know if you guys saw this Bloomberg article reporting some comments from former Fed Chair Alan Greenspan saying that there is no barrier to negative rates here in the United States. So even Greenspan is opening the door to that possibility. Where do you see
the irony of the guy that might have actually opened the door in the first place? But
it sounds capitulative.
Yes, that is true.
Is that the top in bond prices we've seen over the last 48 hours at J.P. Morgan, PIMCO all call for negative yield in the U.S. So let's think about this. What hasn't been as dominant as we would have expected with bond yields going from 2 to 160 over the last month? Well, utilities have been okay, not great. Staples have been okay, not great. REITs have been okay. Shouldn't those groups have been more dominant here if bond yields continue to move lower? I've been surprised by that. Gold today and gold stocks today in particular got hit very, very hard. I'm curious if we're at some type of inflection point on bond yields. That 160, 165 level looks like it wants to hold.
If you want to go bond proxy, where would you go?
Well, I think REITs are still a good way to do that. But, overall, I think it just makes sense to maintain a more defensive posture right now. When I say defensive, I'm not necessarily talking utilities and consumer staples, but more so within tech. And we like tech. I'd rather be software over semis. So companies like Salesforce, Adobe, and then healthcare. Healthcare is a sector that hasn't really performed well.
At all.
At all. And it's been, in my opinion, unfairly punished. I mean, there's great med tech companies out there like Intuitive Surgical, Abbott Labs that are absolutely crushing it, and they're just not getting any appreciation.